Have you ever sold your mutual funds because you wanted money urgently? It could have been due to an emergency or to purchase something. Maybe to pay off that expensive credit card debt or go for that unplanned destination wedding. Well, you could have easily avoided this and let your money compound to fulfill the dreams you have been saving for. Instead of liquidating your investments, you can take a loan against them. Taking a loan against your investments can be a smart financial move. Many millionaires and billionaires in the US don't sell their equity investments in their lifetime. Instead, they take a loan against it. In fact, they fund their entire lifestyle by taking a loan against their assets. According to the Atlantic magazine, Elon Musk hasn't taken a traditional salary as CEO of Tesla since 2019. However, he has pledged the Tesla shares worth more than $94 billion. Larry Ellison, the co-founder of Oracle and America's fourth largest person, has pledged more than $30 billion of his company's stock as collateral to fund his lavish lifestyle. They do this for two reasons. 1. Selling equities means they'll break their compounding. 2. They will need to pay tax on the gains or profits they make. Similarly, you can too use your investments such as mutual funds judiciously to meet emergencies or fund purchases that you would otherwise make by liquidating your investments. You don't need to break the compounding on the investment for which you have worked really hard. Also, you save on paying unnecessary taxes. See, most people first sell their equity investments. Once their finances are on track, they reinvest the money. Therefore, the tax paid on withdrawal is unnecessary, and they dig a permanent hole in your compounding journey that won't get filled ever. Hello and welcome to ET Money, a platform that helps you make smarter financial decisions. We don't just talk about where you should invest, but how you can be successful in your financial journey. In today's video, we'll discuss making smarter financial decisions when taking out a loan. We'll compare multiple loan products to determine which one is the best option for you. We'll compare a loan against mutual funds with a loan against property, an auto loan, a personal loan, a credit card loan. We'll also discuss how the wealthy utilize loans to preserve wealth. So let's begin. Let's say you use your credit card to book a family vacation. You'll have up to 50 days to repay the amount. But you are short on funds by the due date. What options do you have? First, you do nothing and continue to have an outstanding balance and pay as and when you have the money. Second, you can sell your mutual fund units or skip SIPs for the next few months to repay the credit card outstanding. Third, you can take out a personal loan to settle the outstanding dues. Now, keeping an outstanding balance on a credit card can lead to a debt trap. The math is simple. A credit card can charge a yearly interest rate up to 48%. That's 4% a month. The credit card company will also charge you GST on the outstanding balance. If you miss paying by the due date, a hefty late payment charge will be applied. Partially paying a credit card is akin to taking a very high interest loan. You also don't need to redeem investments or skip your SIPs. This will break your compounding. Say you invest 10,000 rupees a month for 20 years and end up earning 12% returns. Now, if you skip 6 SIPs, you'll end up with 86 lakh instead of a corpus of 92 lakh rupees. That's around 11% lower than what you could have earned. If you take out a personal loan, the interest rate typically ranges from 14% to 24% or even higher. A better option in this case would be to opt for a loan against mutual funds. Considering the features it offers, there are hardly any other loan products that match it. First, the interest rates are currently as low as 10.75%. The entire process is digital and super fast, and it hardly takes a few minutes to complete. You can borrow despite a low credit score or even if you don't have a credit history. Many times banks don't lend to borrowers who don't have a credit history. The best part is that you don't have a fixed EMI. You can repay the principal amount when you have the funds. Until then, you just pay the interest every month. Now, these features makes the loan against mutual funds affordable, convenient, and flexible. If you offer equity funds as a pledge, you can borrow up to 45% of their current value. In the case of a debt fund, you can get a loan up to 80% of its value. In fact, let's compare the loan against mutual funds to some other products. Let's say you want to buy a new car costing 10 lakh rupees. For this, you want to take 5 lakh loan. Your vehicle will be hypothecated to the lender as collateral. Once you have paid off the loan, you'll need to obtain a no due certificate from the lender and visit the RTO to terminate the hypothecation. There's a lot of paperwork. First, you must submit multiple documents to obtain a loan. Then you have to complete additional paperwork when you pay off the loan or decide to sell the car. Above all, if you want to finish the loan before the tenor ends, you must also pay foreclosure or prepayment charges. A loan against mutual funds will be cheaper and more flexible, and it involves zero paperwork. You can prepay or foreclose at any time and in any manner you choose without incurring any additional charges. Now, the best part is that your car is not hypothecated and you can possibly negotiate a discount with the car dealer for cash payment. If you are buying a used car on loan where the interest rate can be around 18%, a loan against mutual funds is a no-brainer. Now let's talk about personal loans. When you apply for it, the lender asks for multiple documents, including 3-month salary slips, bank statements, and income tax returns for the past 2 years, among others. Then they check your credit report to analyze whether you are creditworthy or not. The interest rates can vary. If you have a relationship with the bank, the rates can be as low as 14%. If not, it can be as high as 24% or even higher. If your credit score is not up to a bank's requirement, it can reject your application. Mostly, banks prefer borrowers who have a salary account with them or some other relationship. Even if the bank offers you a personal loan, in most cases, you cannot prepay or foreclose it. Beside other things we have already discussed, in the case of a loan against mutual funds, you don't need to provide salary proofs and ITRs. Also, you don't need to have an existing relationship with the lender. What if you have a property? When someone wants to take out a loan of a significant value for home renovation, marriage, or a sudden business requirement, they usually opt for loan against property. While the rates are comparable to those of a loan against mutual fund, availing a loan against property is cumbersome. In a loan against mutual funds, you take a loan against a small portion of your investments, depending on your requirement. In the case of a loan against property, you need to pledge the entire asset even if you are taking a small loan. So why should someone pledge a property worth 1.5 crores, 2 crores for a 15 to 20 lakh loan? Besides submitting documents as you would do in the case of a personal loan, a surveyor will visit your property to assess its value. Now, based on the current value, the lender will determine how much of a loan they can offer you. It can take weeks before your loan is sanctioned. Even if it is sanctioned, the interest rates are higher than your home loan. The interest on both these loans is floating. It means you can benefit if the interest rate in the economy falls. A loan against mutual funds can cater to the needs of anybody. You can take a small loan of 25,000 or go as high as 2 crores. Just one important detail here. If you take a loan against mutual funds from a bank, you can only get a loan of up to 20 lakh. But NBFCs can give a much higher loan. Even if you have an emergency, a loan against mutual funds is a better option than liquidating your emergency funds. When you liquidate your investments, you pay a higher capital gain tax. Taking a loan against mutual funds will be cheaper than paying taxes. For instance, let's assume your investments are in fixed deposits. Breaking the FD would attract a heavy penalty and taxes. If you add that up and compare it to a loan against mutual funds, the latter would work out to be a more cost effective. If you liquidate a debt fund, the gains are added to your income. So if you are in the highest tax bracket, you end up paying 30% tax. In the case of a loan against mutual funds, the interest cost is 1/3 of that. Yes, you'll need to pay the tax when you withdraw. But by taking a loan, you defer your tax payments and let your investments compound. Also, if you plan to reinvest the same fund as your finances get on track, paying taxes is unnecessary. Let's summarize what we have discussed so far. First of all, When you take a loan against mutual funds, you ensure that your investments compound over time. If you plan to reinvest in the same fund, once you arrange the money, you end up paying taxes which can be avoided. It's an affordable option, far cheaper than a personal loan, a car loan, or keeping an outstanding balance on your credit card. It's a floating rate loan which allows you to benefit from falling interest rates in the economy. Taking a loan against mutual funds is entirely digital. It means the process is super fast and convenient. You can get a credit line the same day. Also, there's zero paperwork. You don't need to submit salary slips or income tax returns. You can also get a loan if you have a low credit score. It's flexible. You can just pay interest until the loan tenure and repay the principal at your convenience. In addition, there are no prepayment or foreclosure charges. You don't need to pledge your entire portfolio. Depending on the requirement, you can use a fraction of your portfolio to raise funds. You don't need to have a relationship with any lender and don't have to wait for a valuer to determine the value of your units. Okay. So we discussed real life scenarios and compared products to understand how you can utilize your existing investments wisely to save money and avoid the hassle of paperwork. But where can you avail this loan? ET Money now offers loans against mutual funds. We have made it convenient and easy just like we did with mutual funds. Now in the final section, we'll guide you through the process and demonstrate how easy it is to take a loan against mutual funds on the ET Money app. But before that, let's discuss why the interest rate in this loan is lower compared to other products. That's because it's a secured loan, like a car or a home loan. Secured loans are always cheaper than unsecured ones like personal loan. In a secured loan, you pledge your assets to the lender. The compounding or the depreciation is yours. In this case, your units will be pledged through a digital process and you can unpledge it with one tap. As with a car or home loan, the proof of possession is given to the lender through a lien. However, it's digital. You can unpledge the units with just one tap. Alright, let's now show you how it's done on the ET Money app. At the bottom of your screen, you'll see a menu. Tap on Cash. You'll see the option to avail a loan against mutual funds. Once you tap that and follow the on-screen instructions, the system will verify the maximum credit line you can avail based on your investments. You can customize the credit line as you would want. Next, you have to do an online KYC. Take a selfie and enter some details like the purpose of taking the loan. After that, you need to set up autopay, which will allow ET Money and its partner lender to deposit money in your bank account and also auto debit interest every month. Next comes pledging of mutual fund units based on the credit line you have decided. Even this is done online using an OTP. The screen then proceeds to show the key fact statement and digital signing of an agreement. This was the final step. A credit line will be set up within few minutes if you complete this process before 6 p.m. on a weekday. Outside working hours, it may take a little longer. You can then withdraw any amount of 25,000 or more whenever you want. You have this credit line available to you for the next 3 years. Let's now move to the final section of the video. Now, there's a reason why billionaires rely on credit. They don't want to break the compounding. A loan against mutual funds is a very handy tool in your financial arsenal. It's not only affordable but also more convenient and flexible. This facility allows you to enjoy the fruits of your hard work. The investment journey is gruesome. It takes years and consistency to build wealth. Don't let a bad financial decision or an emergency destroy it. If you have ever taken out a home or a car loan or considered selling your investments, consider signing up for a credit line. You may not be in urgent need of money right now, but you never know when this could come in handy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.